Over the run of the housing boom, lenders made an extraordinary number of extraordinarily foolish loans, incredibly foolish loans. But they were foolish loans because of the incentives that they set up for consumers, not because of consumers being fooled or being hapless saps taken advantage of by banks. It was because of the incentives that they created. Consumers have now responded with a vengeance to those incentives, and that's what created the housing crisis. When consumers rationally respond to incentives, that is not a consumer protection problem. If consumers rationally respond to incentives like they know what they're doing, that is not a consumer protection problem. The loans that banks made presented, I think, quite obviously, very serious safety and soundness problems. When banks are making nothing down mortgages, for instance, that presents a very serious safety and soundness problem. When a consumer takes a nothing down mortgage, has no skin in the game, and later walks away because of the incentives that are set up for him to walk away, that's not a consumer protection problem. And by thinking of a consumer protection problem, we're going to misdiagnose what's going on. So what really happened? I think you can identify three waves to the foreclosure crisis. The first wave was a wave that was caused primarily by adjustable rate mortgages, and this was the underlying cause of this whole thing was Federal Reserve monetary policy. In the handout, what you see is a chart on the Federal Reserve's monetary policy as it reflected in long-term and short-term mortgage interest rates over the past 30 years or whatever. What you see, the interesting story here is first that there's a downward trend in interest rates, which is why housing prices could keep going up, right? Housing remained affordable for most of this time, even as prices were rising, because interest rates were so low. The important thing, though, is if you see the bulge from 2001 to 2004, where our short-term interest rates were taken down very low. We could talk about why that was, but basically what happened was monetary policy created a big gap between long-term interest rates on 30-year fixed-rate mortgages and short-term interest rates for adjustable rate mortgages and everything else that went along with that. Then on the backside, the Federal Reserve ratcheted up interest rates again to the prevailing level where 30-year fixed-rate mortgages. Note, the 30-year fixed-rate mortgage did not really change during that whole period. All it was a change in underlying interest rates. So what that did is what we see is that there was a change then. Consumers flip rationally from fixed rate to adjustable rate mortgages over time. Back before subprime lending was even a gleam in Angelo Mozillo's eyes, if you look back in the 80s and 90s, what you see is there are periods of times where 50 or 60 or 70% of the mortgages that were being originated in the United States in any given year were adjustable rate mortgages. If you turn to the second chart on that page, you see why that is, right? As the gap between a fixed and adjustable rate mortgages, it gets wider or narrower over time, what happens is inevitably consumers understand what's going on and they flip from fixed rate to adjustable rate mortgages. So what we see, that's if you see the chart that shows that spread, the spread there is the difference between fixed and adjustable rate mortgages. Over time, sometimes there's a lag, but invariably, as that spread widens, consumers flip from fixed to adjustable rate mortgages. Why did this not? So what was the implication of this? Well, if you look at the next chart, what we see is our good friend, the subprime mortgages, right? But note the foreclosure rates on subprime mortgages. What do we see? Subprime ARM mortgages foreclosures explode. What about subprime fixed-rate mortgages? What you see is subprime fixed-rate mortgages foreclosures did not rise. The subprime problem was an ARM problem, not a subprime problem. How do I know that? If you look at the next chart, what do you see? The exact same pattern for prime mortgages. Prime adjustable rate mortgages foreclosures actually rose faster as a percentage rate than subprime adjustable rate mortgages. The initial onset of the crisis was caused by Federal Reserve monetary policy that provided consumers with an incentive to switch from flip from fixed to adjustable rate mortgages, either in origination or in refinance. The Federal Reserve then did something that was completely out of the experience of any people in the history of America with the kind of drunken monetary policy that they put us through from 2001 to 2007, whereas they took interest rates down and interest rates back up, and they whipsawed consumers through that, and it took down not only subprime borrowers but prime adjustable rate borrowers as well, right? That was the initial onset, was the Federal Reserve monetary policy and the incentives it set up for consumers who got whipsawed. What happened next? Well, then we saw as interest rates rose, housing prices fell. The second wave then, and the one that's kind of dominated the whole thing, is what we can think of as the option model. Every month you've got a decision. Do I continue to pay my mortgage? And if I continue to pay my mortgage in the end, I can buy the house, or do I stop paying my mortgage and basically give the house back to the bank? You could think of that as a financial option, right? And there's decades of economic research that shows that model describes how consumers make choices. What would you expect? Well, you would expect people to be more willing to exercise the options. The value of exercising the option goes up, or the cost of exercising the option goes down. What makes the value of the option go up? Well, if your house is now underwater, right, it becomes a lot less valuable to exercise that option at the end, right? Giving the house back to the bank rather than continuing to make those payments becomes much more valuable. So what we see, and what everybody who's looked at this finds, is as housing prices fall, consumers decide it's not worth it as much to them to keep paying on the mortgage. They give the house back to the bank.